Hello, it's Rhonda Thomas, and we're just about to do Managerial Accounting's Exam 2 review, which will cover chapters 6, 7, 8, 9, 10. All right, so I have got an example of what we're going to be doing. So here we go. I'm in the problem in Cengage, and I have my spreadsheet ready to go. Okay, so the first two, so they got two from each chapter. So chapter 6 is cost, volume, profit analysis. And the first one we're going to do is called the high-low method. So we use this high-low method to come up with the estimate of the total cost. And then we also know what the fixed and the variable cost components are of that total. Okay, so you're going to get a list of activities. Here are your activities and here are your costs. Put them in the spreadsheet. Okay, and then you're going to pick the one that's the highest activity. Just ignore these numbers. So here's our highest, and we're going to put those in. We'll put the total costs in and the units they produced with that. Then you're going back to which one's the lowest. Okay, so then this is the lowest cost, and it's going to get subtracted from the highest cost. And then the number of units produced for the highest cost. I just got pushed down to the bottom of my spreadsheet. Okay, so the units produced for that the highest units produced minus the lowest units produced. Now these two numbers are what's left over after you subtract the low cost from the high and the low activity from the high. Then step 2 is finding that variable cost. So the variable cost is 135,000 divided by 2,700, and you get $50 of variable cost per unit. So I put 50 in. Now we're ready to isolate. Now that we know what the variable costs are, let's isolate the fixed costs, right? So we start with the total cost of 378. If you'll just stick with your high cost all the time, you'll know what to do. Then we're going to subtract, okay, minus the variable cost of $50 per unit times the number of units that go with that cost. So 4,050. So we're going to do a subtraction here. Total cost minus total variable cost. Okay, so total cost minus total variable cost leaves you with fixed. Okay, so let me total cost minus total variable cost. This is variable cost. Here is our fixed. So fixed is 175,500. Okay, so then we have to put this into an equation. Okay, into an equation. All right, so the equation is the total cost equals 100, and so total cost equation. Okay, let me move this over just a second because I want to make sure you know what we're doing here. Okay, so in the total cost equation is total costs equals, equals 175,500 in fixed plus $50 times the units they want us to use. They want an estimate of the total cost for 1,940 units. We have to start with fixed, and then you take the $50 times the number of units that they are requesting, and that is 97,000, and then you add these two together and you get total cost of 272,500. Okay, so that's walking you through the high-low method, and there's 4 steps involved. Okay. All right, this next one is break even. Okay, let me see if I can refresh your memory just a minute. You need to have sales minus variable cost equals contribution margin minus fixed costs equals operating income. For break even, operating income is 0. So you need to have just enough contribution margin to cover all of the fixed costs so that your operating income is zero. Okay, so they're telling me that my sales price is $310. They say the variable cost per unit is $250. So that leaves us with a unit contribution margin amount of 60. So they're doing things in units here. Okay. So we know our fixed costs are 756,000. Okay. So let's do one at a time. We're going to do one with a selling price of 310 and one with a selling price of 340. Let's stay with the 310 to begin with. So there's a calculation to find your break-even units, the number of units. So you take your fixed expenses, 756,000, and divide by that unit contribution margin. Okay. And when you do that, I get this many units. I get 12,600 units at a sales price of 10. Okay. That's how many units it's going to take to break even. And then if they ask, although they didn't, they could have put something here beside here. How much is that in break even dollars, right? In break even dollars. So you would take the units you just found times the sales price. Okay, this is the old sales price. Okay, let me just put old here because I don't want you to be confused. Okay, and if you had to put in what the break-even point in sales dollars is, it would be 3,906,000. Now there is another way to find the break-even dollars in sales dollars. You simply take the fixed costs and divide by what's called the contribution margin ratio. Okay, contribution margin ratio is up here. So sometimes it's good to, and we can do this by the unit, right? So our cost of goods sold is 81% of our sales price, and that leaves 19% left over for contribution margin. So you would take the fixed and divide by 19% or 0.19, and you get that same answer, okay? I don't know if you'll have this in your exam. On some of my multiple choice questions, I kind of did a random one. So in case they ask you that, there you have it. Okay, now we're going to compute a new break-even price by, a new break-even amount of units. And it is, just a minute. Okay, and it is, since we are raising the sales price to $340 from $310, and everything else stays the same. Now we have quite a bit, we have a larger contribution margin. So it should take less units. Okay, less units. All right, so here's what we've got. Our fixed cost stayed the same. We're going to divide by our unit dollar contribution margin of $90. Okay, and that gives us 8,400 units. And if they happen to say, well, how much is the break even in sales dollars, then you would take it times the new price of $340, and you have break even in sales dollars of 2,856,000. I know they didn't ask for that, but I did want to show you that. Okay. Okay, we're moving on. We are moving on. Okay, we are moving on to chapter 7. Chapter 7 is our costing for management analysis. Okay, number 3. So this is called variable costing. If you look up a variable costing income statement, this is for the month of February. you'll see that it is sales minus variable cost of goods sold. You get a subtotal called manufacturing margin. Okay, so I am going to put an asterisk for when that is a subtotal. Okay, subtotal. Okay, so let's put this in. They gave us $710,000 in sales. We're going to subtract the variable cost, and we get our first subtotal of 376,300. Okay, so that'll be your manufacturing margin. And then we're going to subtract the variable selling and admin. Okay, and so 71,000 is mine, variable selling. And now we're ready for the contribution margin. Contribution margin is 305,300. Okay, and then we take the two fixed. So the fixed manufacturing of 106,500 and fixed selling and admin of 42,600. Okay, and you subtract both of those to get your operating income. So just to help you remember, before we did variable costing income statement, we did sales minus cost of goods sold is gross profit. And then we would put selling and admin. So there were fixed cost of goods sold up here. And there could be, yeah. So we're trying to segregate all the fixed down after the contribution margin. That's what we're trying to do in variable costing. Okay. All right, let's go to number 4. Okay, this is two segments of a business. Okay, and they're going to have volume of a product called Alpha and Omega. Okay, now I have put mine together a little bit differently. So if you'll make 2, right? So here is the Atlanta segment contribution margin. That's what we need. And we want the Pacific segment contribution margin. I put volume of Alpha and Omega. Alpha and Omega. So I've got Alpha and Omega going this way. So here is the volume under Atlanta for Alpha and Omega. So I got 8,800 and 5,100. I need a sales price for those. Okay, sales price is 14 and 20. Okay, so I put 14 and 20, and there is my sales. So you take the sales price times the volume. Okay, then you have variable costs. Okay, and what you have to do is the variable costs are $8 for Alpha and $12 for Omega. Okay, and here's how I got the variable costs. I took 8,800 times the variable cost of 8. Okay, and then this one is 5,100 times the variable cost of 12. Okay, so then this gets subtracted. So I've got it subtracted here. That's fine. I was putting in negatives, but let me fix it. Let me fix it. I'm going to put this in as a negative. Now I got to change my formula. So just a second, but I wanted to stay consistent. Wanted to stay consistent with what we have been doing. Okay, so we've been putting in anything that we subtract with that. Now I need to change this. Okay, so now my contribution margin is my sales less my variable costs. Okay, so let's get this. Okay, and then we'll move this over here. So here's our contribution margin, but we need to put in a total contribution margin. So we have a contribution margin for alpha and a contribution margin for omega for the Atlanta segment. And that is your first number. Okay, your first number. Okay, now over here, I'm going to do the same thing. All right, so it looks like for Pacific, it's 9,700 is for alpha and 10,500 is for omega. They've got $12.18 for the sales price. So there are the total sales. And then we are going to put this in as a negative to follow the same pattern that we have been doing. Oops. Okay, so we want equals 90, okay, equals a negative 9,700 times its variable cost, okay, times its variable cost. There it is. And now I need to change my formula to add them together since I'm putting that in as a negative. Okay. And we only want it from here to here. There we go. All right, so there it is. And I've got to change this one now. Okay, got to change this one now. Okay, and then this one is a negative. So it'll come out a negative. Okay. Okay. So back where I was. All right. So now we have for Pacific, their alpha product has a contribution margin of 38,800. Their omega product line, and I need to add these together because that's way too much. See how that's way too much? Yeah. So we want just these two. All right, there we go. So that's more reasonable. There is the 101,800. So when you add these two together, you get the 101,800. Now they want the contribution margin ratio for each of these segments, right? So here's the number when you add those two together, which is also right here. Now, how do you get contribution margin? It's your total contribution margin divided by your sales total. Well, we don't have sales totaled, but we do have both of them here. So here's how I'm getting this. I am taking C87, which is 93,600. That's the total contribution margin divided by these two sales added together. Okay. And this is going to be a percentage. So they want it one decimal place. So I got 41.6. So over here is the same thing. We take the contribution margin divided by the total sales. You could do a total sales and add it up right here beside it if you wanted to. So, I mean, that's up to you, but I just did it in a formula. So then this one becomes 33.3. Okay. All right. So now we're moving on to number 5. And it is going to be chapter 8. Chapter 8 is the budgeting chapter. So let me put that down. Okay, we want that up here. I must have, okay, so this is number 5. All right, the first one we're going to do is a direct materials budget. Okay, direct materials budget. Okay. So let's see what they say. It says Crawford Candle budgeted production of 750,000 units. Notice I put that down. Okay, it's important to realize how many they're budgeting for production, because that is, you have to know that to get to what we're about ready to do. It says, and this is for the month of September, wax is required to produce a candle, and they use, their standard is 11 ounces of wax for each candle. So I put 11. Here's how much wax we have in ounces, right? In ounces. Sorry. Okay. In ounces, and we have to convert those ounces to pounds. Okay, so how do you convert ounces to pounds? You divide by 16. Okay, divide by 16. Okay. Sorry, I just got a tornado warning. Woo! All right. Well, I'm in the tornado shelter, so I'm gonna keep pushing. All right, we're now to how many? Remember, we know that it's 11 ounces per candle. So 11 ounces times the number of production is 8,250 ounces. To convert that to pounds, you have to divide by 16. So we're starting with candles and the number of pounds of wax that we need. All right. And then it says that, so now we want to add the desired ending inventory. They want 14,400 pounds. So we're going to add that to how many total units available, right? So this is all we have. So, because we're trying to decide how many pounds of this wax we need to buy for the production in September. But then you subtract your beginning inventory, right? And here it is, 18,400, but that gets subtracted. So now we're down to the pounds that we need to purchase, 511,625, and my price is $2.10 a pound. So I got 1,074,413 as my total, okay, that I need to purchase. Okay, here's the second one for the budgeting chapter. This is your direct labor cost budget. Okay, so I always recommend trying to figure out the production units above anything else. Okay, so it says that we budgeted production of 60,000 units. So this is a different one, but that's okay. So here is our expected candles to make, and it says that we assume that 10 minutes are required to mold each candle. So 10 minutes and 10 times 60,000 candles is 600,000 minutes, but we don't pay people usually in minutes. So we need to convert it to hours, okay? I'm sorry, we divide, okay? We're gonna divide 600,000 by 60 minutes to get the number of hours that we are estimating, okay? And we pay $12.25 an hour, okay? So that means that our total direct labor cost is 122,500. Okay, we're done with chapter 8. On to 9. Okay, 9 is our variance chapter, our evaluating variances from standard costs. And once again, before you get started, it's a good idea to put down how many actual units were produced. Okay, so in this case, and they'll throw all this information at you, where you have to figure out what to do. Okay, so when it comes to variances, this is direct materials variance. We're going to find the price variance first, and then the quantity variance, and then we're going to net these two. So we're starting here, okay, the actual quantity of direct materials. And by the way, 5,500 units, used, if 5,500 units, that is the number they produced. If they use 61,700 pounds, I've got that there. Our price that we paid was $7.68. Okay. The standard price is $8, and it's up here. Okay. And now we have to come up with how many standard quantity. I think this is the hardest one. So we have to take our actual units times the amount that they have as a standard per unit. They have 11 standard pounds per unit. So if you take 5,500 times 11, you get an amount of 60,500. Now let's do this before we go any further. Actual quantity, 61,700, standard quantity. Those are pretty close, but we've used a little more than what the standard says. Now let's compare the price. The actual price per pound that we paid was $7.68, and the standard price was expected to be $8. So we're doing a little better with our price. So I think with this information, and it's 11 pounds per unit, and then I figured out if you took 61,700 divided by the number of units that you're making, we used a little beyond the pounds, right? Yep. So I think we're going to have one favorable and one unfavorable. So let's see how this works. I recommend, instead of that three-prong approach, I do like the way this book presents this. So we're going to take the actual quantity, so 61,700 times, and we're going to compare the price. Okay, so we paid $7.68, standard was $8, and we're going to get a variance then. So we take the actual quantity times the difference between the prices, okay? And that is a favorable variance because it's negative. And the reason it is favorable is because actual price of $7.68 is lower than the standard price of $8. Okay, so I did put a reason beside there so you would know. So I put a negative 19,744. Now you be careful. The last one I did had a favorable and an unfavorable, and this one is actually unfavorable. I just didn't fix it. All right, unfavorable because our actual quantity was bigger than our standard quantity. Yep. All right, so let's see if we can walk this one out. So we've got 61,700 actual quantity. It should have been 60,500, and then we're going to take it times the standard price. So that gives us an unfavorable variance, and the reason why it's unfavorable is because we used more than we were supposed to. Okay, so these two go in, and when you net these two, you get the total direct materials variance. But this favorable amount is hiding this unfavorable one here, because we're actually more favorable than we realize, because this one is sitting here unfavorable. Okay, so those get netted. And like I said, if you know, okay, good grief. I guess you can tell that we're having a little weather over here. So all right, so I've got to hurry up a little bit so I can get out of here. All right, here comes the second one for our variances. And this one, we're going to evaluate direct labor. Okay, so we just did direct materials. Now we're going to do direct labor. It's kind of similar. All right, but for this one, let's find how many units they're producing. So units, 4,500 units. Yep. Fish that out. All right. And then your actual hours that were worked, 18,700 hours. We're paying $17.10 an hour. The standard is $18. Standard rate is $18. Okay. And okay, so once again, we've got to figure out our standard hours. And once again, you have to use your actual units produced times the standard. So the standard is how many hours? It's supposed to be 4 standard direct labor hours per item. So if we made 4,500, the standard amount of hours should be 18,000, and that's pretty close to what we got actual. But we actually spent more time than we should have, but we're paying a lower rate than the standard. So we're going to have a mix again. So let's get started with our direct labor rate variance. You take your actual hours, which is 18,700 times 1710 minus 18. Okay, and that's where this number is coming in at. Okay, so we have a favorable rate variance, which we figured that would happen because we're paying less than the standard. But now the time variance. Okay, we're going to take actual hours minus standard hours times the standard rate. Okay, and the standard rate, let me put this in here. I didn't have this in here right. So this should be $18 is the standard rate. Okay, $18. But I do think we're okay here. Let me just double check. Yes, this minus this times this. And that got us an unfavorable variance because we are using more hours than we're supposed to. We're only supposed to be using 4, but we're using 4.16. So we have a favorable and an unfavorable. Okay, because actual rate, not price. Price is for direct materials. So I want to make sure I have this in here correctly. Actual rate is lower than, okay, actual rate is lower than standard rate. Yep. Actual rate is lower. So this is favorable. But we spent more time than we should. So this is unfavorable. So our hours were larger than they should have been. So you've got a favorable variance of 16,830, an unfavorable variance, and the net of the two is a negative 4,230. So this favorable variance, this is the total direct labor variance when these two get combined, but we don't know what's going on until we break it out like this. Okay, and when we break it out like this, wow, favorable under the rate was even more favorable than we knew it to be. And then the time, unfortunately, was unfavorable. Okay, last two. Okay, this is a operating income for a profit center. All right, this is evaluating decentralized operations. Okay, so just one moment. Okay, make sure that things are still, okay, we're still working. All right, so we have a profit center. Remember, profit centers are responsible for costs and profits and income. Okay, so they should be able to explain what's going on. So we got 2 divisions. We got a retail and a commercial, and we've got a service department that needs its expenses, right? So I put data analytics, $340,000 needs to be allocated over both of these, right? So it says the retail division has 2,000 hours of data, and the commercial division did 6,000. So together that added up to 8,000 service hours for the period. So this division used 25% of them, and this division used 75%. We will get to this down here, but let's put in our sales first, right? They gave sales. So if you look at the retail and all you knew was sales, you would think that this was the superstar. All right, let's go ahead and subtract the cost of goods sold, getting us to a gross profit. We go ahead and subtract those selling expenses, and we get something called operating income before the allocation, the support department allocation. So data analytics is our support department. Okay, and remember, support departments don't bring in any revenue. Okay, so they often have to be allocated over profit centers that do have. Okay, so we're here, and the way we divided up this $340,000 is we took 25% of it for retail, and then we took 75% of it for commercial, and we put that in as a negative. So we would then get operating income. Okay, operating income. So that's what they want you to do in this one. And you just have to understand this is all about the allocation. Okay, and I think it makes sense. Okay, so if this is the total expenses of data, and they had their services or their support for 6,000 of the 8,000 hours, then yeah, they need to shoulder that. Okay, they need to shoulder that. And now when you get down here, whoa, look what happened, right? I know this is still the superstar, but what really hurt this one is that. Okay, so if they wouldn't have had as many, but anyway, that's what they want. All right, last one, and we're done. Okay, we're going to do a little return on investment. Okay, return on investment is a percentage that you find, and you need, so we've got the retail division, and I went ahead and put my divisions across this way. So we have a retail division, a commercial division, and a data analytics division. And then I put my two measures of operating income and invested assets. So here is operating income. Now they're going this direction. I've got them going across. Then I took these invested assets and pushed them out here. And then the ROI is found by taking your operating income and dividing your invested assets. And they only want it to a whole percentage. Okay, so we took operating income and divided by its invested assets. Okay, so if you look at each of these, data analytics is the winner, right? That's being the most profitable per dollar invested. Okay, that's it for now. I am going to say goodbye because I'm going to try to go home in this weather. So let me stop sharing my screen here, and we'll see you on the next video. Be safe.